Welcome to Fundamentals of Accounting, Module 3, Lesson 3, the second stage in the accounting process. Today, we are going to learn about one of the most important habits in accounting, journalizing transactions. What is journalizing? Journalizing, it is the act of recording financial transactions in the general journal or its equivalents in the exact order that they happen. It's like writing a daily diary for the business. Every financial event, every sale, every payment gets its entry. In every journal entry, we must include the date, the accounts affected, the debit and credit amounts, and a brief explanation called a narration. Now let's go through a step-by-step guide for journalizing transactions. Step 1. Gather the details of the transaction. Before writing anything, you must first know what happened, how much money was involved, and which accounts will be affected. For example, on April 1st, 2025, the business buys equipment worth $150,000, and the payment is made through a loan. Step 2. Identify the accounts involved. Now, you must analyze carefully. Ask yourself, what did the business receive or gain? What did the business give or owe? In our example, the business received equipment, which is an asset. At the same time, the business took on a loan, which creates a liability. Step 3. Decide which account to debit and which to credit. To make this decision, we use the rules of debits and credits, which follow a simple pattern. Let me read this small but important table slowly and clearly for you. Account type, asset, increase by, debit, normal balance. Debit account type, liability, increase by credit, normal balance. Credit account type, equity, increase by credit, normal balance. Credit account type, expense, increase by debit, normal balance. Debit account type, revenue, increase by credit, normal balance. Credit. Let's pause here. Assets and expenses increase with a debit. Liabilities, equity and revenue increase with a credit. Applying this to our equipment purchase. Equipment is an asset, and it increased, so we debit $150,000. Notes payable is a liability, and it increased, so we credit $150,000. Step 4. Write the journal entry in the correct format. Every journal entry must include 1. The date, 2. The debit account first, 3. The credit account next, indented to the right, 4. And a short explanation at the bottom. Here's how our example would look. Date, April 1st, 2025. Equipment, debit $150,000, notes payable, credit $150,000. Short explanation. To record the purchase of equipment on credit. Remember, debits are always written first and aligned to the left. Credits are always written second and indented to the right. Step 5. Double-check your entry. Always check. Do total debits equal total credits? Are the account titles correct? Is the narration clear and short? Mistakes here can create bigger errors later, so be very careful at this stage. Why is journalizing so important? Recording entries in the journal ensures all business transactions are captured properly and provides a source document that accountants and auditors can review. Your ledger, your trial balances, your financial statements, even your tax filings. Every transaction must affect at least 2 accounts, and the total debits must always equal the total credits. Let's now move into real-life scenarios. Example 1. Purchase equipment with cash. Transaction. The business buys a printer for $10,000 and pays cash immediately. Journal entry. Date, April 5th, 2025. Equipment. Debit $10,000 cash, TEF month. Credit $10,000 to record purchase of printer. Example 2. Receive a utility bill, not paid yet. Transaction. The business receives a $2,000 electricity bill to be paid next month. Journal entry. Date, April 25th, 2025. Utilities expense. Debit $2,000. Utilities payable. Credit $2,000 to record the electricity expense incurred. Example 3. Owner invests capital. Transaction. The owner deposits $50,000 into the business bank account. Journal entry. Date, April 1st, 2025. Cash quantum. Debit $50,000. Owner's capital, credit $50,000 to record the owner's investment. Key takeaways from today's lesson. Journal entries are the first formal record of a business transaction. They keep transactions organized in chronological order. They must follow the rules of debits and credits. Each entry must balance, with total debits equaling total credits. The narration is short but important. It explains why the transaction happened. End of Module 3, Lesson 3.